let me resume recording. So again, just for the recording purposes, we're here for Cody Touchette to kind of give us some insight into residential lending, because we're in a very challenging time. And folks who has projects that they had in limbo, like all of a sudden with lender situations. We also want to kind of talk about a little bit about, like basically he's here to kind of talk about capital market, how it works, and what should be the reasonable expectation, because we're looking for refinancing and all that sort of stuff. Some of the underwriting criteria, and also forbearing impacts and etc. Because some people were saying, hey, if we don't have to pay mortgage for a little bit, can I just declare forbearing? What does that mean to me? And also what happened to the projects that's in limbo. So today's feature is going to be very dynamic. So we have the files, because all this is like so late and new. So we have all the files in all different formats. Cody was able to kind of share some of the up-to-date information on lending. Cody, tell us a little bit about yourself.
Yeah, you bet. So my name is Cody Touchette. I work at Caliber Home Loans. I run a team called the Touchette team. We're out of the Bothell area of Washington. I've been doing residential mortgage lending for about 20 years now, just over 20 years. And I've been an investor myself as well since 2008-ish is when I started flipping homes, when the market had a crash back then and the mortgage meltdown, 2006, 7, 8. Started flipping homes until about 2011 when I started holding on to houses more, because they seemed to be going up in value rather than going down in value as we were chasing them down in 2008 and 9. So when I started to have better luck with properties buying either at auction or short sales or foreclosures, and then holding on to them, renting them out. And so during that window of time, becoming an investor, I really found a passion for helping investors and people acquire more wealth through real estate. I was doing it myself, and I started to work with a lot of clients doing that. And now I've talked with a lot of family and friends about doing that as well. And obviously now things have changed a little bit in our world. So I really like to relay what's going on and the new changes here as well. I don't do commercial lending, but I have commercial properties. And so I understand a bit about that in the sense of the challenges and the differences there. I'm in the middle of trying to buy a 42 unit building in Tennessee right now, and that's become challenging over the last month or so. But generally speaking, vanilla flavored and residential stuff is what we do. A lot of that, we help a lot of people with BRRRR projects, and we do a lot of buy and hold investing as well.
Awesome. Thank you, Cody. And, I'm really glad that I get Cody, because he's so busy during this time. For some folks over here that already know Cody, I get referred to him whenever my investors, so I don't do a lot of residential multifamily stuff. I only focus on multifamily stuff, so not a lot of residential. But anytime when there's a weird loan that comes up, like where I ask people like, hey, where can somebody kind of do this, from my investors, people always refer to Cody. So it was really great to have him here. So we're going to kind of dive into the capital markets a little bit. And again, guys, this is a very interactive session, which is why the benefit of a webinar versus recorded session. So put your question in Q&A. I know some guys, some folks over here are from like out of state, but ask the question. A lot of these informations are federal related too. So we're going to start a presentation over here. Again, Cody is going to talk about the capital markets a little bit. So I'm going to have to share and jumping in between a lot of different applications. I've never done this before. So I will be doing some of this. So at any time, if you feel like, hey, there's a box over here that's blocking your view, let me know. I can kind of adjust it. Just put this in the chat box or the Q&A. Cool. All right, Cody, go ahead.
Yeah, you bet. So this is a graph of the MBS market, which stands for mortgage-backed securities. Mortgage-backed securities are the underlying security where when I get a mortgage and Elisa gets a mortgage and everybody else gets a mortgage, they get pooled together and sold on the secondary market. And the fact that they can be sold on the secondary market is what allows lenders to continue lending, right? Most lenders don't have billions and billions and billions of dollars to just keep lending money out. So they issue a mortgage, they pool it up with other mortgages, and they sell it on the secondary market. So what this graph represents is the mortgage-backed securities price. And as the price goes up, the yield or the interest rate we see on new mortgages goes down. And so we like those green days. Green days are great days. And so if you start from the left-hand side, you can see those were relatively normal moves. There's probably 15 to 30 point moves every day that's about a week. And then you'll see where COVID is above, and you see those 5 red days, just bam, bam, bam. That's the week where the stock market lost lots of value. The mortgage market lost a lot of value. There's a lot of folks that were figuring they were going to be unemployed. This is when the stay-at-home orders were starting to be issued. And then we had that emergency Fed meeting on a Sunday night where there was unprecedented. They decided to move short-term interest rates to 0 to 0.25 as a target rate for the Fed funds rate, lowering them by 1 percentage point. And the bigger issue for us in the mortgage world, well, that was an issue for us in the mortgage world because immediately people called and said, I want that 0% mortgage. Well, that's not exactly how it works, right? So the Fed funds rate is the overnight rate. The overnight rate, banks lend to each other, very, very short-term type money. But what they did commit to was buying mortgage-backed securities. And that's what we like to see. And so you'll see there was a big 5 days of red activity, and then it jumped up, which we thought, okay, this Monday is going to be okay. And then all of a sudden we lost everything that we gained on Monday, and then we lost again on Tuesday, again on Wednesday, again on Thursday. And you can see the level of the moves of those days were really, really big. Just a lot of volatility, big swings up and down. And then on Friday of that week, right where the V starts to go back up, that's when the Fed really stepped in and bought a bunch of mortgage-backed securities. And so the way that works is it's just simple supply and demand. The more you have of something and the less demand you have for it, the lower the price goes, okay? And so going into that COVID week, we were issuing lots of mortgages, right? Mortgage volume was really, really high. And that week, everybody stopped buying. And so what happened was we had lots of supply and we had zero demand, so the price just kept going down and down and down and down. And when the price goes down, the yield or the interest rate goes up. Then the Fed comes in and says, we'll be the buyer, right? We're going to be the ones that buy this stuff because no one else wants to buy it. So they step in and they buy it, but they didn't commit enough to buy enough to really prop up the markets, just enough to take up extra supply, but not really help the markets. So then the next week they said, you know what, we're going to do whatever it takes, right? And so they said, we're going to jump in and whatever it takes, we're going to spend it. So that second week that they started buying mortgage-backed securities, they bought $168 billion worth of mortgage-backed securities in 1 week. And that was more than they had bought in any 1 week, even dating back to the housing crash in 2006 and 7 and 8. And so that really pushed prices up, which normally you would think, well, prices going up, yields or interest rates are going down, that's a good thing. The problem was the whipsaw between the two, right? So it's twofold. There's really 3 issues why mortgage rates aren't as good as they could be today. One is supply, right? We are working on a triple to quadruple the normal volume right now. So underwriters can only underwrite so fast. Processors can only process so fast. Appraisers can only appraise so fast, right? So we have more volume right now than we can get through the funnel. Also, you saw this big movement up and down. That movement creates a strife or problem inside of pricing where if somebody locked at the top level here and then all of a sudden now it's down at the low level, that they might think, well, geez, what do I do here? What's going on? Or now even worse, they lock at this low price level and then rates get better immediately right after, they want to renegotiate the lock. So when you lock in an interest rate on the secondary market, you're promising to deliver that. And so if you promise to deliver that at 4%, and then a week later, the going rate is 3.5%, chances are you're not going to deliver that loan. But what happens on the secondary market is the mortgage company goes out and hedges that bet. So effectively, they buy that money at that price. And so if they buy it and they deliver it, they make their profit on the mortgage. They might lose a little bit on the hedge, but they made the profit on issuing the mortgage. But if they buy the hedge and they don't issue the mortgage, well, now they lose on both equations, right? And so that's a big loser for mortgage companies. And so that and one other thing created a lot of margin calls. So basically, if you're a stock investor, you can invest in stocks, but without having to not having to use all your own money to buy those stocks. Let's say you want to buy 100 shares of Microsoft at, I don't even know where it's at, maybe $150 a share. $200 a share, let's say. You're going to buy 100 shares, but that would be, I don't know, what is that? $20,000. But you say, well, hey, I want to buy a bunch of stock, but I only have $10,000. Okay, your company that you're with, Ameritrade, E-Trade, whoever it is, says, okay, we'll let you pledge your $10,000 worth of cash to buy $20,000 worth of stock. And if it goes up to $30,000, everybody's happy, right? You're in good shape. But if it comes down in value to 15, we're going to need some money back, right? So if that value of that asset's only 15,000, then they're going to call you up and say, hey, we need some money, or you got to sell your position. And so the same thing happens in the mortgage world. And so when the value of that goes down, that's a problem, right? And so if you're not going to deliver on those locks, that's an issue. Yeah. Then also with forbearance and all the layoffs that we've got, now we've got payment risk, right? For the collection, just like all of us landlords are thinking, man, are my tenants going to pay? Well, the mortgage companies are thinking, man, are my borrowers going to pay, right? Are these people going to pay their mortgage payment? And so with all the unemployment filings and all the people that issued or asked for forbearance when they first issued that as a possibility, well, now the value of servicing is not going to be there because they don't expect that they're going to get all the payments that they got in February or March, in April, right? So April, May, June is going to be a really tough time to be a mortgage company collecting mortgage payments, because some people are not going to call you and they're just not going to pay. A lot of people have already called and said, hey, I'm not going to be able to pay, give me the forbearance. But either way, a mortgage company still has to pay their coupon payment, right? They still have to pay for what they issue. And so then in that case, what happened was servicing used to be valued at about 1%. So if you had a $100 billion portfolio of mortgages that you were servicing, then that $100 billion portfolio would be worth $1 billion. And let's say from a margin standpoint, you could issue 10 times your value in new mortgages. That means a mortgage company could issue $10 billion worth of mortgages in a month. That's a lot, right? That's plenty. But now what happened was overnight, that value of servicing went from 1% to 0.5%. So the value of that asset underlying allowing the mortgage companies to do business got cut in half. So if you could issue $10 billion in mortgages last month, now you can only issue $5 billion in mortgages because of the capital requirements. So that, all of those things all put together really is what stopped the mortgage pipeline for a bit of time, right? You can see there was 3 really big volatile weeks that happened, and we didn't exactly know what was going to go on, right? I mean, it was the good news, the Fed's helping. Oh no, what the Fed did didn't actually help. It made it worse. And then we actually, as an industry, we asked the Fed to slow down, right? And that's where you can see on the far right of that graph where it's kind of leveling out. The Fed, they understood what they were doing. They heard from us, and they didn't stop, but they really slowed down what they were doing.
So is this my understanding then, like just kind of get my head kind of wrapped around this too, is when the Fed is injecting a lot of money into the markets, this means potentially they increase the competition. So hence the rate was higher. Is that like how I should think about it?
So when they're injecting money, it increases the price because yes, it is competition. Now they were the only competition, right? There's almost no one else buying mortgage-backed securities. But yes, that raises the level of demand as a whole, and so that raising of the demand will increase prices, which then in turn pushes rates lower.
Right.
And so what had happened though before they made that big commitment to buy a bunch of mortgage-backed securities was mortgage companies, not only were they swollen with volume already, but now they're like, nobody's buying this stuff. We don't really want to issue it anymore. So we saw rates go way up, right? So, I mean, we were seeing rates in the high 4s, low 5s for owner-occupied transactions for a brief period of time. Now they're back, right? I mean, if you're owner-occupied transaction, rate, either rate and term or purchase, you're probably in the low 3s for a 30-year fix, right? So things are really, really good historically again. But there's been some products that have suffered because of this, right? This is Fannie Mae and Freddie Mac. This is not FHA, right? Now there's Ginnie Mae, which they're also buying some of those. But then the other outliers are non-QM stuff, non-qualified mortgage stuff. So that's your portfolio lending, and jumbo, right? Jumbo loans that are not included in this. So if your loan size nationwide, the limit is 5, 10, 400. And in King and Snohomish and Pierce counties where we're at, it's up to 741, 750. So if you need to buy a house, let's say you want to buy $1 million house at 20% down, well, you're in jumbo territory, right? That's an $800,000 loan. Those loans are a lot more difficult to get than they were 3 weeks ago.
Because they're purely backed by private investors versus Fed has anything to do with that.
Correct. That's right.
Gotcha. That's very useful. You know, Cody, I just as you're talking over here, I think we can take a whole session talking about this. This is very, very interesting to me in terms of macroeconomics. So I'll definitely kind of follow up on some more deep dive sessions on just kind of the theories of how capital market works and et cetera. Because I think as investors, we always look ahead. You know, so all these theory kind of put together helps us in terms of thinking about what type of loan that we should be getting in terms of when we purchase a product.
Yeah.
Cool. I'm going to move on to the next couple topics over here. This is really insightful. So I'm going to pull up another sheet over here in terms of appraiser updates that you have shared with me. Let me know if you're seeing it. Yeah. Okay.
You may need to scroll a little bit, but yeah, that's we've got it. Oh,
okay, cool. Let's see. Okay, because it was not pulling up. Okay, here. This one? No, this is.
No, that's not the right one.
Okay. See, we have multiple files over here. All right.
Yeah, I think you had it right. There you go. You just might have to scroll down a little bit. It's a bigger.
Yeah.
So yeah, I mean, the long and short of it is, with everything going on, people don't want appraisers in their houses, and appraisers don't really want to go into people's houses either. And so we are allowing for a desktop review in some instances and exterior only in some instances. And Fannie Mae and Freddie Mac have issued a lot more property inspection waivers as well. So when we run through, and you can't really tell until somebody like actually gives us their information, because it's a full underwriting, full automated underwriting. And so we plug it into the system, and then either the DU or LP system will generate an approval, and it will tell me whether or not we need an appraisal. So property inspection waivers are gold right now. They've been gold for quite a while because you can save them, $700-800 on an appraisal. But now it's really great because I've got 2 or 3 transactions where we do need an appraisal, and the clients will not allow an appraiser to come in, right? And so those are loans that are locked right now that we cannot move forward on that we otherwise would, because we need an appraisal and they can't go in the home.
Gotcha. So here's a standard, and this is something, Cody, you think we can share with them?
Absolutely, yeah.
Okay, great. So I will share this report over here, but basically this chart over here is probably like kind of the big takeaway is, which helps you kind of understand that, like, if you have a flip or if you have a primary housing or house hacking that you want to get into, what you should be kind of expecting in terms of appraiser procedures over here. So as some of us may not want to have appraiser comes in, or like Cody said, it could not order them. So these are kind of like the products to kind of think about in terms of using it. I love this because, it's even though we're talking about residential loan over here, but like our aspect of business, it's all tied together.
Yeah. And one of the other things that we're doing too is we've kind of put out a guideline to appraisers of basically how to do it too, right? So some clients still won't allow for it, but others are just a little nervous about it. So what they do is they say, hey, turn on all your lights, open up all your interior doors, and as an appraiser, I will walk through your house, take the pictures I need, make the measurements, but I won't touch anything, right? So you leave all the doors, interior and exterior, open, so the air's coming through, right? And we're not capturing germs. They're wearing masks, they're wearing gloves, they're wearing booties, in and out of the house. So they're doing their best to try to, not spread, but still keep business going for everybody involved.
Great. Awesome. All right. So we do have a Q&A session over here. Are you ready to take some questions on like the first session you talk about capital markets, Cody?
Yep.
So we have Dean asking, it seems to me like that so-called mortgage company hedge is, like you said, exactly like trading on margin. Isn't this a bit of speculative play for large mortgage lender?
Yeah, so it's not in that sense. The hedge is more of a protection, right? It's not a doubling down. It's a bet. It's a bet against, right? So they're going to say, hey, you want to lock in this 30-year fixed rate at 3.5%. Cool, we're going to commit to that. But I'm going to buy a hedge just in case things go the other way and things get worse, so that I can still deliver this. So it actually is if everything goes according to plan, the hedge is a loser for the mortgage company. It's if the loan is delivered on time, the hedge is a loser, but it keeps us more level. It's not a double down, right? So if you deliver the loan and we make money on the hedge, that's never how it would work, right? The hedge is just a loss mitigator.
Gotcha. Cool. And then another question over here was back to the appraiser. Again, we'll share this report with you. Henry had a question about what determines whether a digital appraiser is allowed versus physical appraisal.
Yeah, we have to run it through the approval engine, and that will tell us. But generally speaking, if it's rate and term, where you're just paying either a purchase or a rate and term where you're just paying off the existing mortgage balance, not getting cash in hand, and you're at 20% equity and you have a better than a 720 credit score, you'll probably get a PIW or a property inspection waiver, unless the property is super unique and there's not any comps, right? So what they're doing is they're going out to electronic versions of appraisals and they're judging based on the confidence score and the value. So the other thing is if I am as a loan originator, say, hey, we need to do this loan and it's 400,000 and the property's worth $1 million. If they feel like the property is worth 900, then I'm not going to get a PIW. But 900 is plenty in that transaction. So what we do is we try to estimate on the low side, but still in the right zone. Because if you're too far off one way or the other, you're not going to get it, right? And so it is a little bit of a guessing game, and we try to do our research with the electronic versions that are out there and available, iAppraisal, Zillow, Redfin, whatever, and try to come up with a number that's about right, and then we run it through. If it's under 70% cash out, then LP or Freddie Mac will possibly issue a property inspection waiver as well. If you're at 80% cash out, you'll never get one, right? So there's places where we know that you won't get it, and then there's chances are higher at certain levels, but it's still a little bit of a crapshoot because we have to wait for the automated engine to give us a result.
Gotcha. Well, this is really cool. I think I just kind of hear about this is, again, this is important to kind of working with potentially a local lender or someone who has this pre-appraiser stage, kind of with more research, right? Like you guys do more research into it before it even hits the appraiser stage versus, sometimes I do the internet lending and sometimes it's kind of like a crapshoot, even when the time is good. They'll tell me the loan can be closed, but then the appraiser comes in, could be like totally off. So there's a difference in terms of who do you do lending with. It's something to kind of keep in mind. And good question to ask as well. Cool. So we're gonna move on to our next topics over here, and just kind of do a sharing on the guidelines. So how do you actually get a loan? I think you have what is our guideline now? Because now we hear, in the times that's tough, typically what we noticed is the lender kind of does the pullback, which makes lending a lot more harder to qualify. So I'm sure the audience over here is kind of interested in here, like, hey, what can we actually qualify? And who can qualify in terms of the loans and et cetera.
Yeah.
I know you have a slide over here. I have it up. Yeah.
Sure. Yeah. This is just one example of some of the things that have changed recently. And this is in regards to, we've helped a lot of folks along the way that want to buy lots of rental properties where they'll take one of the spouses off of the primary residence to free up cash flow to buy others. But what this is telling us now though is if the current owner does not have a primary residence expense, whether it be a mortgage, even ownership with taxes and insurance, or a rent payment, that in most cases you're not going to be able to use the income from the new rental to help qualify on the new property.
So this is kind of huge, right? Like for people who are flippings and et cetera. So I know a lot of my audience investors, they have a couple rental going on. They do this, there's also the limit of 10 per person. So they do the spouse, I don't know what you call it, but arbitrage or whatever. So basically, I also used to go to BECU, try to get a HELOC or try to get another loan being told by BECU, which is really annoying. Like, unless if the income is showing up on your balance sheet for 2 years, which I never was able to qualify, because if you're in a growth mode, 2 years is just too long. So in this case that you think people who are, actively pursuing deal, that if that income is not showing up in their 1-year history, then this is likely not counted. So that's actually pretty huge for people who does volume in residential space. Yeah.
Yep. And then some other ones that I don't think we have a necessarily slide for it because it is a fast moving, fast changing market that we've got. This just came out too. Chase, as a national institution, just came out that if you don't have a 720 credit score and 20% or 700 credit score and 20% down, they're not going to issue loan.
Gotcha.
Yeah. So they've taken away anything outside of that product mix, which is just unbelievable. And I mean, Jamie Dimon was around the last time we went through one of these crashes. He's not a dummy. And that is just a huge segment of the market that's not going to be able to buy with Chase. Now, that doesn't mean Chase is your only option. Obviously, we'd hope that they wouldn't be your first choice because that would be us, right? But that just goes to show that, big companies are making big sweeping changes to what they're willing to offer right now. Most mortgage companies that offer the jumbo lending have pulled that back. Chase and Bank of America and Wells, I think you can still get a jumbo through their retail channels, but they've totally killed wholesale. We still have opportunities to do jumbo, but it's dramatically different than what it was like before. FHA, USDA, VA loans have really tightened up as well. We used to go down to as low as a 580 credit score. Now that minimum is 620. So that's, and that 620 to 659 has some overlays. So you either need to have 120% residual income. You need to have 6 months reserves, or make sure you're under a 45% debt to income ratio. Over 660, those overlays don't apply. One other thing that's come up recently too is self-employed folks. If you don't have 12 months reserves, then you're going to have a 25% haircut on your income.
Gotcha. Okay, 25%.
And that's pretty big.
Yeah. Without 1 year reserve.
Yeah, 12 months reserves would be the requirement.
Yeah, that's amazing. So like in my case then, I always like to kind of demonstrate with the examples and whatnot. So let's say I quit my job last year, went financially free. Most of my income's coming from rental, obviously. I have a huge depreciation that I write off with. The income is still pretty good. So it's likely I won't qualify for any loan, like residential loan per se, in your opinion, the conventional residential loan.
I'd love to take a look at it personally because in residential, I get to add back depreciation. So depreciation is a non-cash expense. So I get to add that right back. So if you're showing losses on your rental income mainly because of depreciation, that's okay. We can add it back.
Gotcha. Cool. That's awesome. And then what about the W-2 versus not W? Actually, I have a question on the residential, like this chart that you just show over here. Can you explain a little about, is it better to not own a principal resident then based on this requirement?
No, you'd want to, you need to have some sort of housing expense, right? So whether it be owning a primary residence or having or renting a place, or even, if you're on the title with your spouse, but you're not on the main mortgage, then we would still count against you the taxes and insurance, and that still counts as a housing payment, so that's okay.
Gotcha. Okay. Okay. Cool. All right. So I have another question. I think we're going to address this later when we're talking about forbearance. So we have a question about what's the different types of forbearance. We'll keep that question in mind when we touch base on that particular section of our presentation over here. So forbearance, let me see. Okay. The technology struggle over here. I'm trying to pull up a forbearance chart. I think that's our next topic, right, Cody?
I think it is, yeah, and I can start going into that. So, the long and the short of forbearance, the way that it's written right now with Fannie and Freddie, is it is a temporary suspension of payments. And so they will start with 3 months. And let's say you got forbearance for April. You're not going to pay your April, May, or June payment. But on July 1, you'll be responsible for 4 full payments. Okay? So Fannie and Freddie rules as it's written, they are not tacking 3 months on the end of your loan, like some people think, or maybe even was portrayed in the media. That's not what's happening with Fannie and Freddie. Now, if you have a loan that is a portfolio loan, right? Coastal Bank, Washington Federal, something like that, then those guys can make their own decisions. And they very well might tack 3 months on the end of the loan for you. And if so, okay. Our philosophy on it is if you don't need it, I wouldn't take it, right? And the reason being is that we're all in this game together. And if too many people take advantage of a system, and again, I want to be clear on this. If you need it, take it. It's not taking advantage. But if you don't need it and you take it, it's kind of using the rules in your favor, right? It might be considered taking advantage of it. And so if too many people do actually take advantage of it that don't need it, you could break the system. And breaking the system could present all of us with huge problems, rather than if you can make your payment, move on. Let's hope we get out of this that much faster. Too many people do it. We're going to see what happened in 2007, 8, 9, when people just threw their hands up in the air and said, oh, you know what? My house is worth 10%, 20% less than I paid for it. It'll never come back, right? I can't tell you how many times I heard that in the biz in 2007, 8, 9. It'll never come back. I bought my house for 400. It's worth 250. Never, right? And what do we know, right? Hopefully we learned from that last time, right? I'll give you my own personal example. I bought a house in late 2006. I moved in on Thanksgiving, right? That was the worst time to buy a house, right? I saw it just go, and then, so I bought around 900. It might have been worth 9.25 at the peak. And at the bottom, it was worth like 6. And I don't know if I could have sold it for 6, right? Nothing was moving. And so then I could afford the payment. I just kept making my payment. I was in the mortgage business, so I didn't have the opportunity to be able to strategically default because it could risk my license. So I was making money, I paid the bill, and I just kept on riding it. The house was great. I lived in it. It was fine. In 2018, I sold it for 1.15, right? Nice. So I ended up making about $250,000 on it. Now, it took a lot longer than I expected, but I wrote it out and I made the payment and I was okay, right? So if you can ride it out, I think that's always going to be the best bet for the greater good as well. If you can't afford it and your tenants aren't paying, you've lost your job, by all means, get forbearance, right? But at the end of 3 months, they're going to be looking for the 4 full payments. At the end of 3 months, if we're still not working, now who knows, right? Things are changing fast. But as of right now, you could get another 3 months, up to about 12 months. At the end of 12 months, though, the way it's written is that you'd owe 13, that 13th month, you'd owe 13 payments, or you'd have to go into like a loan modification. And if you do a loan modification, well, we saw that last time as well, 2009, 10, 11. A lot of people were trying to modify their loans, and it didn't go super well, right? The banks needed, you have to show need, 100% have to show need, right? If you don't have need, they're going to say, pay my money. But if you have need, then it's going to be pay stubs and tax returns and unemployment benefits and like showing all the reasons why you can't make the payment. And then you're going to have a modified loan, right? And as we came out of the last time, if a loan was modified, we would not be, Fannie Mae and Freddie Mac would not allow us to refinance it. It was just off the table.
Wow. Okay.
And so the other piece of this is if you take forbearance on anything, car loan, credit card, student loans, mortgage, you're not going to be able to refinance your existing mortgage. So if you have a mortgage now and you take any sort of forbearance, you're cutting yourself out for the next 3 months worth of great opportunities in the mortgage world. So I would say if you can pay your payment now, at least make the payment. And then let's see, because there might be a really great opportunity in the next 30 to 60 days to refinance. And if you're caught in that middle of that forbearance, you won't be able to take advantage.
Gotcha. So again, taking an example, hypothetically, someone like me, one of our property is under Airbnb, so it's not pulling any income because we pulled it off the market. Yep. Let's say, I can't pay my mortgages right now, but if I went to forbearance for that particular property, and that means I can't come to you, Cody, to say, hey, in the next 3 months, like my other 2 properties, I want to get them refinanced. And you're like, sorry, you can't really do that. Now, what happens after the 3 months expired? I paid up to date. So then I can do the refinance and et cetera.
Yes. Yeah. And that's an important thing to keep measure of too, is that credit, right? That's the other piece of this is if you just don't make your payment, your credit's going to get hit. If you call and you get forbearance approved and you don't make payments over that 3 months, and then you catch it up on that 4th month and everything's good, it will not show up in your credit one bit.
Gotcha, gotcha. And then, so what if someone then, I know we should do it for the better good for everyone, but some people will ask questions,
Sure.
right? So if
Yeah.
someone was looking at like a flip projects, or maybe now it's a longer flip projects, not really a traditional flip. It's like I hold it for 1 or 2 years, house hacking, let's say, and then renovate. By the way, all the construction has now stopped in Washington State, right? So, but if you
Yeah.
bought it, it's your primary residence, you're just updating itself by yourself, like, okay, that's still probably allowed. So let's say someone's taking that strategy and then they're like, I'm just going to go forbearing for like a year. And then after a year, my stuff is modified how I want it. Then I can rent it out. Sure, I'll pay the bill by the end. Like, is there anything that is going to catch up to them?
I don't think not as long as you follow.
It's a very unique scenario.
Right?
I know.
Yeah, no, I mean all the the greater good aside, right? The rules, I don't think so.
Right.
No, I think you would be, as long as you followed the guidelines, right? You got the forbearance, you got it granted, and then it came to the end. You could show need, and you actually got it modified. Then no, it would not be net negative.
But in general, instead of doing forbearance, it's probably much better going to your banker and maybe negotiate a lower rate by means of refinance and et cetera. Because some of us still have mortgages that's in the fives for investment property.
Yes,
so much better to just do a refinance and lower the rate. And also there's someone tell me this trick too, like if you close by the end of the beginning of the month or something, so you can potentially just basically not, like your statement really started like a month and a half later.
Yeah.
Almost.
So that's a great point, right? And that's when people call and they ask us about forbearance. I ask them, "Are you still working?" And they're like, "Yes." And I said, "Well, why don't we refinance instead?" And
Right.
they say, "Well, what do you mean?" I said, "Well, you're 4.25. The going rate on a owner occupied 30-year fixed, no cash out, is probably 3.25 or thereabouts, right? If we refinance, we'll schedule this for, you'll need to make the next payment, but hopefully we can get it closed before the second payment's due. Make that payment. And then, yes, we could skip one or maybe up to 2 payments. And if you have equity in your home, you can get up to $2,000 cash back as well. So effectively, you could skip 3 payments, right? If you had a $2,000 mortgage payment, we could set it up so that if you closed, let's say you closed May 15th, right? You could not pay May, you could not pay June, and I could hand you $2,000 at closing that you could use to pay July. So hopefully that'll get us through this mess. I don't know, right? Maybe it will, maybe it won't.
Gotcha.
But at least now you got a better payment too, right? Like if you drop a 4 percentage point, that's worthwhile.
Exactly. And then in the life cycle of the whole loan, you're paying less of an interest.
Sure.
I'm asking these because I'm always creatively thinking about problems. And then so Henry has a question about, this is related to a session that you were covering before about appraiser. Have you seen appraiser value coming down so far? Like, how are you seeing in the residential markets right now?
Well, you know, that's funny because I would expect that to happen a bit, but appraisers work on comps, right? So now commercial, totally different animal, but inside of our residential world, we're looking at comps. And right now, I've got to tell you, our March, we closed, or in April, we're going to close more purchase volume than we did in March and February combined. So, I mean, now a lot of that came from contracts that were issued in March, right? While we were still, or I guess, late February, early March, while people were still wandering around town and not stuck at home. We'll see what May looks like. But that said, I mean, we're getting in more contracts every single day. I write a lot of pre-approval letters. The pre-approval letters, I'm asking, hey, what are you offering? And they're saying 10 over list, 20 over list, or list price. I'm not writing a lot of pre-approval letters that are lowballing folks, you know, for offers. So if purchase volumes keep up, then those comps keep getting reset at higher and higher levels. An appraiser won't have ability to lower values if the comps don't support lower values, right?
I see.
So if we started to have a lot less sales and those sales coming in 5 or 10% under market or under list price, then I'd start to worry. But we're not seeing that so far.
So you see most of this kind of diverge from the topic a little bit more. Just that's my question. Are you seeing most of the stuff that could come in? Because I'm just kind of thinking, for people who are invested in, you know, real estate, they're landlords and etc. There's obviously a lot more stress during this time. I mean, we haven't seen a full effect right now. We think the sentiment is May it's going to be worse than April. That's what we're thinking. So a lot of these people probably also have some money, right? So are you seeing kind of like there's a segmentation difference, like in terms of luxury products now maybe pull back a little bit, and then the regular investment housing is still pumping like as ever?
Yeah, that's been an interesting topic we've kind of been on some masterminds about, is that I've always been a workforce housing sort of guy, right? Like
Yeah.
2-bed, 1-bath in Linwood rents for $1,200, in Arizona rents for $700-800, right? So like
Right.
that kind of like moderate level. I'm not a C or D class buyer, but I like that B-ish type of maybe C plus, right? Where it's got a little value add proposition, but it's also not gang activity, not a lot of drug activity, that sort of thing, right? So those have been really profitable through other recessions. This one's a little different though, because the people that work or the people that rent those places might not be working, right? And so I always thought luxury was going to get crushed the next recession we had, but luxury renters are probably working at Amazon, Microsoft, and Google and just working from home in their luxury apartments, right? So they're okay, right? I don't know, right? I mean, it's going to be interesting to see how this shakes out. So far, all of my tenants are paying, and the ones that are unemployed are on unemployment. And if you're COVID impacted, you're getting extra unemployment. You're getting a $1,200 check, maybe more money down the road. So, I mean, so far so good, but I mean, it's going to, May and June are going to be the telltale signs for sure.
Gotcha. Cool. And another last question is the forbearing actually showing up in a title or record?
It wouldn't be a title thing. It could be a credit thing. So it will show up on your credit while you're in it. So that's what's going to keep us from being able to do something, right?
Right.
But it won't be a long-lasting mark if you satisfy it at the end of the period.
Gotcha. And then would it affect your credit score while you have it?
I haven't seen one of those yet. I honestly don't know the answer to that. Yeah, I don't anticipate it will, because it's not going to show as late. So it probably will be more like a student loan that's in forbearance, right? Which we see that all the time, and that's not a negative. But if your student loan goes from forbearance to I didn't arrange the next thing and I missed a payment, your credit score will drop big. So
gotcha, makes sense. So make sure that if you're thinking about forbearance, give them a call, satisfy all the requirements that they have, and keep that communication open. So you don't want to just kind of ignore the slips.
We were getting just barrage with phone calls on this early on, and so we didn't have the capacity to set up. So Caliber Home Loans anyways, we've added a bunch more lines, a bunch more people to answer the phone, and now we've got an online way you can do it as well. So if you're check with your servicer, go to their website. I'm sure the front page of their servicing website is all about what to do if you're in trouble. So.
Gotcha. Cool. I think I missed the slide over here that you have prepared, which is just kind of going back to the employer overlay.
Okay.
I'm trying to open this up over here and see what I got. Sorry, working with multiple stuff over here. I think it's this letter. Yeah. Can't see my screen, of course. You see
on your screen.
Yeah, you seeing it? Still seeing that. Okay, let me see. Okay, is this showing the right stuff over here?
Yeah, there you go. COVID-19 income and employment overlays. Yeah. So these are some different things that we've come up with, or that have been either caliber related or just industry related. One of the other big things too is verification of employment. We used to need a full verification of employment within 10 days of closing. That's now moved to 3. So we have to validate that people are unemployed right up until closing.
Gotcha.
Yeah, and probably the biggest thing with regard to servicing and that we talked about was if the first payment default, right? And so that's where loan products that are really stuck on that, like FHA and state bond, if we issue a mortgage and that person doesn't make their first payment, that loan is no longer saleable, right? So it cannot move off. It cannot move off the lender's books without going to what they call. And it sounds funny, but like as flippers and property owners, you talk about appliances and scratch and dent, right? You get a $1,000 fridge for $600 because it's got a little dent in the side, but who cares? So mortgages, there's a scratch and dent market as well, which sounds funny, but there is. So you could buy a $400,000 loan on the scratch and dent market for maybe 30% discount, right? And the only thing that might be wrong with it is now in this new world we live in is maybe they signed up for 3 months of forbearance to get through this. So likelihood is good in 3 to 4 months. If we do come out of this well, there could be some mortgages that might be worth buying on the secondary market in the scratch and dent market, right? That would be an opportunity out of this, because the only thing that was wrong with them is they lost their job temporarily and signed up for forbearance. And now it's a really good loan other than that, right? But it's not going to move off of a mortgage company's books because Fannie Mae won't buy it, Freddie Mac won't buy it, FHA won't buy it.
Gotcha. That's actually a great opportunity because like our investors, we invest in multiple different vehicles. So note funds or directly invest in notes that has something to do with this is something to kind of keep in mind coming couple months. Great. Awesome. So I know that we also talked about like, hey, what happens if a flipper or a person who is kind of currently going through a transaction and kind of in a limbo? What are some options for them right now to kind of look into?
Yeah, well, I think there's a few, right? And I've been kind of brainstorming with some of our clients on this as well. And one of them, which sounded kind of funny, but one was to list the property, right? There are people out there with cash that are looking for opportunities, that are looking for deals, and you're 3/4 of the way through flip might still get you paid something and get out of it before you run into trouble from a credit perspective, or you burn your hard money lender by not paying them, right? So just selling it, right? There's a lot of activity. There's a lot of demand for homes right now. And if you don't qualify for this or couldn't do this, and this is kind of another option of how to get out of it, is they could do a renovation loan, right? So if you sell that property to an end user, they could buy it with a 203K loan. They could buy it with a home style renovation loan and finish the project on their own with their own colors and with their own whatever. And there's a huge appetite for that sort of thing right now. So selling it would be one way to get out of it. Another is to take that type of loan, right? If it's a house hack and you're planning on living in it yourself and you run out of funds, you could do a 203K where we basically build in the renovation budget you can do that as a purchase or a refinance. So you can refinance into a 203K. If it's not owner occupied, so that's strictly owner occupied. If it's not owner occupied, then you could go with a home style renovation. So that is also, it's a conventional version, but it will do owner occupied or non-owner occupied. The hang up there is that you do need to hire a GC and you've got to have full bids, plans, specs, everything all lined up in front. So a lot of our flipper buddies and clients are, doing the work themselves, or maybe fly by the seat of their pants a little bit more, where they don't have all those bids and plans and that sort of thing.
Yeah.
So it's not as flexible, but it's way less expensive than hard money. It's just more hassle, right? So it's more headache to get ready.
Yeah.
Alternative too, I've got one of our flipper clients that just called me and said, hey, I need 30 grand to finish this deal. What would you need from me as profit on this deal to give me 30 grand, right? To finish the deal. And so, I don't know, 30 grand, second position, if you stand to make 50 grand on the deal, I don't know.
That's pretty good.
Is 10? I mean, could I get 10 on 30 and only be in it for 30 days or 60 days?
Yeah.
I don't know. I mean, there's people with cash right now that are looking for opportunities. And then there's people, obviously, that are stuck in projects that they'd like to get out of. I don't feel bad about investing in something like that right now because the demand's still so super high, right? This is just a vanilla flavored flip that's, and then a family's going to buy it, right? A family's going to buy it and move in and love it. So there's a lot of those families out there that are looking for homes. I've got, probably 100 pre-approved buyers that are out looking, and some of them have pushed pause, but some of them are in terrible living situations that got to get out of, right? Family moves across country. They're living in an extended stay with, 3 kids and a dog.
Yeah.
They got to get in a house, right?
Yeah. Oh yeah, definitely. Now, are you seeing more of these people? Like, you think this is gonna create more home ownership, or do you feel like more people potentially, like if this is going on for another a month or two, you feel like people is gonna potentially lose more of their home, in the residential world?
I think so. The difference between this time and last time, right? So if we go back to 2008-ish, the difference is there's a couple differences. One is the speed at which the government is reacting, right? This is unprecedented speed, right? Like within a week, we had a major Fed move that was there to prop up the market. Within 2 weeks, we had a promise to pay X number of dollars to every household in America that needed it. and unemployment double benefit, right? Like the movements that they've made is dramatically different. And the other piece is that the folks that have already bought houses have really decent credit quality, right? A lot of equity in homes, and there's the folks that have bought houses over the last 5 or 6 years have decent credit, right? They've verified their income. Now, whether they're working right now or not, that's another story. But when they went into it, they verified their income, they verified their credit, and they probably had some down payment. Back in 2005, 6, the loan standards were wild, wild west, right? I mean, it was fog a mirror, you get a mortgage, right? And not only do you get a mortgage, but you could do a negatively amortizing mortgage where you're not even paying all the interest earned by the mortgage company, right? So the credit quality and the mortgage quality is dramatically different this time. I think it's going to be more difficult for new buyers to be buyers, right? That we've seen that in the credit standards tightening up now, even more so than they were before. And so, so I think from I always try to find the opportunity in everything. As a landlord, I think that means I'm going to have more renters, right? Like these people that otherwise would have taken advantage of an FHA low down payment loan with their 620 score. Well, they're going to keep needing my workforce housing, right?
Yeah, exactly. Yeah, that's the reason why I was asking, because as you know, I'm more doing the multifamily stuff.
Right.
Cool. So kind of move on. We got like only a couple minutes left, but I want to just kind of skim through the rest of the presentation over here about the rates, where we at, and then you have a couple graphs that you want to show.
Yep. So again, I'd like to end kind of on more of a positive note. Rates are amazing, super, super good, right? Even if you shade more to investing in multifamily, refinance your primary residence, right? Like now is a great time. Rates are super low. I'm a big cash flow guy, so I really recommend 30-year fixed rate mortgages. And a lot of times people really want that 15-year mortgage. I always say if you've got any other debt that's at a higher percentage interest rate than 3.25% on a 30-year fixed, then you should not take a 15. You should take a 30 and spend your extra money on your other debts, car loans, credit cards, even your multifamily properties, right? If they're above 3%, you should be prepaying that one, not this one. Though the resident or the commercial properties have more interest rate risk, right? Are those all 30-year fixed rate mortgages? No, probably a lot of them are on 5 or 10-year ARMs. So those have interest rate risk. 30-year fixed doesn't really have interest rate risk. So the amount of time you can see we've spent below 4% has only been since the big crash, right? We did not ever have rates below 4% before that. So keep that in mind and understand that anything with a 3 in front of it is amazing.
Yeah, agree. Cool. Well, maybe I should give you a call on refinance after this.
We can use your rental income. That's not a problem.
Yeah. So that's great. Okay, so I'm gonna pull up, but this last slide that you have prepared was the shell housing.
I like that one a lot too.
Yeah, and then just kind of wrap that up with our presentation.
Yeah,
cool.
So the reason I like to talk about this one is, excuse me, this goes back to 1975, and the big red line there is a 5% average appreciation from 1975 forward. And this is nationwide, right? So Seattle area, maybe more. San Francisco area, quite a bit more, right? There's different areas that will have different numbers there, but this is national average. If you graphed 5% appreciation, you can see the peaks and the valleys and the valleys and the peaks. And guess what? 2020, we're right on target, right? So inside of your pro formas, if you're putting in a 3 or 4% appreciation rate, you're probably a little conservative, and that's okay. Like I'm conservative too. But the reason I bring this up is if you're buying for the long run, you're going to do okay, right? Like I said, I bought a house in late 2006. That was dang near the peak of that graph, right? But what happened was over the next 5, 10, 12 years, we got it back and then some, right? And so if you're buying long-term real estate, you're going to do just fine. I would say this is an opportunity to be a buyer at a discount, right? If you can get a COVID discount, buy some real estate. If you find a great deal, don't be afraid to go after it and get it. If it does go down a little bit between now and then, just know that it's going to come back and it will long run, it'll make you money.
Yeah. And then somewhere I saw over here too, this is actually one instance where based on the green advisory, somehow the multifamily is usually more secure. But this is like one incidence where the multifamily was actually rated higher on the risk chart or, depreciation chart versus the single family. It seems like the prediction was that single family wouldn't be hit as hard versus like the multifamily potentially. But I think the multifamily is probably a short-term thing. Again, I think Congress perhaps is working on some stimulus package specific for landlords as well.
Yeah. So one other thing to add to there, Lisa, real quick, and I know we got to go, but the gray bars, it's a little hard to see them, but the gray bars that go up and down, there you go, that one. Yeah. Those are recessions, right? And so what I like to look at is how the housing prices do inside of a recession. And if you start from the left, right, so the 1980s, you look at that little blue line. There you go, that one. So you look at the little blue line inside of that gray bar. And what's that little blue line do? It goes up a little bit,
going
right?
Up. Yeah.
And then the next one, the next blue line over, or the next gray bar over, is a little skinny one. But what do housing prices do there? It stayed level.
Stays same. Yeah.
And then the next one in the 90s, you see, it looks like maybe a little bit of a drop, right?
Yeah.
But fairly level, a little bit of a drop. And then the one in 2000s actually goes up a bit, right? Yeah. And so that was kind of the really big start to our spike up. And then the one that we all remember the most, right? Where everybody's thinking, oh man, housing prices are going to go down inside of a recession. That happened there. But if you look before that recession, you can see housing prices had already started going down. And so that recession was caused by housing. And so it's a little different animal, right? All the other recessions, you had to look at, hey, what did housing do inside of this recession that was caused by something else? This recession was caused by housing and effectively really poor credit quality, right? Like that was a big anomaly, and it lasted a lot longer than most. And housing prices went down during that time frame, but they were already traveling down and at a pretty good clip. So then we bounced and then we started going back up again. So I'm personally not super afraid of housing prices inside of a recession. Now, a massive amount of unemployment is a different story, right? That's going to really hurt. If we get to 20 or 30% unemployment for a prolonged period of time, that's going to really hurt everything. Yeah,
absolutely. The jobs is really kind of hurting people. Well, we got one more question over here, and I think it's a really good segue for me to leave up Cody's contact information over here. So we have a question about, do you do loans outside of states?
Yeah. Sorry. Working from home, right? The dog's barking.
Yes.
Okay. So we do. Our company, Caliber Home Loans, is in all 50 states. I'm individually licensed in a number of states. And if I don't have my personal license there, if you got a lot of business there, we'll go get it. That's no problem. And two, if not, I've got local area processing that can help us in any one of the 50 states.
Cool. That's awesome. Awesome. Let me check if we have any other questions over here. I do want to do a poll. This is my first time doing polls, so it's got to be experimentation. Let's see. Oh, okay. I don't think it worked. But anyway, I wanted to do a poll to just kind of see what everybody wants to see for the next session. You can also just put down in the chat over there. Is this session really useful or not? Like, just give you a thumbs up or raise your hand if you think it's really useful. If you want to see some other topics next week, I have my wonderful CPA coming over and talk about stimulus packages and all that sort of stuff. And also COVID-19 related, the CARE Act specific, IRS changes and etc. So that's going to be a really great session to kind of tune in. So I'm going to leave the Cody's information over here. This session is recorded, so I will send out the recording as well. Once we kind of wrapped it up over here, it will be a YouTube link, etc. that you will get if you register for this. And thank you very much for everyone joining us. And thank you, Cody, for your very, very, very valuable time, because I know you're super busy.
Thanks for having me. Great to see you.
All right. Sounds good. All right, everyone, stay safe during this time and continue investing.
All right. Take care.
Okay. Bye.